October 29, 1929, 16 million shares traded in a single day, a record that stood for almost 40 years. In 4 days, the market lost a quarter of its value. It would take 25 years to fully recover. And here's the uncomfortable part. Almost every mistake that caused it, we've made again since. This is the story of 1929, and the lesson we still haven't learned. In the 1920s, the stock market wasn't just hype. It was riding a real boom. Cars, radios, electricity, all spreading into homes for the first time. The Dow grew roughly sixfold in less than a decade, hitting a peak of 381 points in September 1929. The experts backed it too. Yale economist Irving Fisher told the public stock prices had reached, quote, a permanently high plateau. President Hoover reassured Americans the economy was sound, and a new product, investment trusts, the mutual funds of their day, let ordinary people hand their money to experts and feel like they were investing safely and wisely. If you were alive then, reading those same headlines, you'd have believed it too. But the warning signs were already public. 1. Borrowed money, stacked in layers. Investment trusts weren't just holding stocks, they were borrowing to buy more of them, and then other trusts borrowed to buy shares of those trusts. Goldman Sachs's own trading company had roughly $55 million of its $250 million in assets tied up in one nested trust alone. Later, analysis found these trusts were typically leveraged around $8 of debt for every dollar of real capital. 2. Regular investors were buying stock with borrowed money too. Margin buying let people control far more stock than they could actually afford, putting down as little as 10%. Great on the way up. Catastrophic the moment prices turn, because it triggers margin calls. Brokers demanding their money back immediately. 3. A direct public warning got mocked instead of heard. On September 5, 1929, analyst Roger Babson told a conference, quote, sooner or later a crash is coming and it may be terrific. The market dropped 3% that afternoon. The very next day, Irving Fisher, the same economist, publicly rebuked him. Newspapers ran a string of rebuttals from Wall Street's biggest names. Babson had actually been warning about this for 2 years. He was ridiculed for it, right up until he was proven completely right. 4. New stock issuance exploded. In a typical year, new stock issuance across the market averaged around $500 million. In 1929, it hit $5.1 billion, mostly investment trusts, selling hype faster than the underlying businesses were actually growing. Then it happened, fast. Black Thursday, October 24th, panic selling. Black Monday, the Dow drops nearly 13%. Black Tuesday, another 12% drop on that record 16 million share day. 4 days, a quarter of the market's value, gone. It didn't stop there. By July 1932, the Dow had fallen 89% from its peak. Some of those leveraged investment trusts lost over 90% of their value. By 1933, unemployment hit roughly 25%. Thousands of banks failed, and since there was no deposit insurance yet, people's savings simply disappeared with them. The Dow didn't close above its 1929 peak, again until November 1954, 25 years later. Years to build, days to collapse. So why call this what we never learned instead of just history? Because the same 4 warning signs, heavy borrowed money, leverage stacked on leverage, skeptics getting mocked instead of heard, and money chasing hype faster than real growth, showed up again in 2000 with the dot-com bubble, and again in 2008 with mortgage-backed securities. And right now, in 2026, U.S. margin debt has hit a record high of over $1.4 trillion, concentrated heavily in AI and data center stocks, a fact multiple market strategists have flagged on the record. That's not a prediction that a crash is coming. Nobody can time markets reliably, and concentration or leverage alone doesn't guarantee a collapse. But the pattern is worth knowing, because it's the same pattern every time. It isn't the leverage itself that fools people. It's how normal and safe it feels right up until it doesn't. The market doesn't need to lie to you to be dangerous. It just needs everyone to stop asking whether the price still makes sense. If this was useful, subscribe. I break down financial history like this every week.